Is the US economy on the verge of a recession in 2025? And if this recession happens, what's going to happen to home prices and stock prices? And just how high could the unemployment rate go? In this video, I'm going to give you all the update on the economic indicators and what's happening with Trump's presidency so you can be informed on where the economy is heading. And the first thing to understand is that a lot of corporations are giving big warnings. For instance, Delta just issued a big warning on the economy. Meanwhile, United Airlines just slashed its forecast, with Dollar General saying that consumers are cash strapped, and you have Target issuing a rough first quarter profit warning as well. With a big indicator that's scaring me on the economy right now being job openings. For instance, you can see data from Indeed.com is showing an almost 40% contraction in job openings over the last 2.5 years and down almost 10% year over year. And at the same time, continued unemployment claims are rising. We now have almost 2 million continuing unemployment claims. This figure keeps increasing gradually and suggests it's becoming harder and harder for people who have lost their job to find a new job. And one thing that concerns me about the current state of the situation is what the Donald Trump presidency is doing right now. Because the Trump presidency is kicking out the legs of the economy, particularly government spending and particularly immigration. Those were the two main factors that were propping up the economy over the last 2.5 years. You know, the fact that our debt to GDP ratio is now up to 121%. Well, Trump has been pretty insistent on scaling back federal spending, and they're doing lots and lots of layoffs. Over 200,000 federal workers have been laid off already, and now we're also seeing many federal contractors also get laid off from their jobs, and this is contributing to economic weakness and an economic slowdown. For instance, United Airlines just said that government travel is down 50%, which has been a pretty material impact in the short term on their business. And anecdotally, folks, I can tell you, down here in Florida, I am hearing lots of stories of people who moved down here during the pandemic who either worked for the government or were a contractor for the government, and they're now getting laid off or they're being reassigned. This is a trend that I keep hearing and running into on the ground here in Florida. And so the message here is that the layoffs from the Trump administration and DOGE, they are starting to have an impact on the economy. Now, the other side to this equation that I think is causing this economic slowdown is immigration. For instance, I want you folks to check this data out from the US Customs and Border tracking the Southwest land border encounters by month. How many people are being apprehended by Border Patrol? And what do you see? In February 2025, there was only 12,000 enforcement encounters at the southern border, whereas a year ago there was 189,000. So literally there's been a 94% reduction in inbound immigration into the US year over year since Trump took office. Now, from an economic perspective, simply, what does that mean? That means less job growth. There's going to be less growth in non-farm payrolls, and we might even see some of those immigrants leave the country, which could lower consumer spending on the margins. And there was actually a really interesting study by John Burns Real Estate Consulting on the impact of immigration on rental housing demand in America. They came out with this study last year, and they found that slowing immigration could lower the number of renters entering the market, decreasing occupancy rates and cooling the strength in absorptions. In particular, they found that from 2022 to 2024, immigration was responsible for all of the net 1 million growth in renter households in the US. Let me repeat that, folks. John Burns Consulting found that over the 2 years from 2022 to 2024, the only growth that came in renter demand in America was from immigration. So now that immigration is going potentially to zero or maybe even negative in some pockets of the country, what is that going to do to demand for apartments and single-family homes to rent? Well, obviously, it's going to drop. Rents are likely to decline in many of these markets, and that could cause a knock-on effect of a worsening economic downturn as housing inventory rises and home prices drop. Now, let's do a quick little update on the housing market, everyone, because I think the housing market also tells us a lot about the economy. Are people feeling confident enough and wealthy enough to go and buy a house and put a down payment on a house and take out a mortgage? And new data from Redfin is showing that pending home sales, home buyer demand is down 6% year over year through the first week of March. minus 6% year over year, meaning the sales are lower than they were at this time last year, and they're way lower than they were 3 or 4 years ago. In fact, pending home sales in America are at the lowest level of all time today. So we still have not seen any bounce back in home buyer demand from lower mortgage rate, from Fed rate cuts, from Trump being elected. Nothing yet has stimulated buyers to come back into the market, which is just yet another sign of the malaise that we're experiencing economically. And I actually polled all of you out there, and I was curious. I said to you, and I asked you the question, what would need to happen for you guys to buy a house right now? Like, how much would the mortgage rates need to go down for you to step into the market and to buy a house? Well, 18,000 of you voted in this poll, and it's really interesting to see the results. I asked the question, what mortgage rate would make it worth it for you to buy a house at current prices? Only 2% of you said you would buy at a 6% rate. Only 6% of you said you would buy at a 5% rate. 34% of you said you would buy at a 4% mortgage rate, while 58% of you said that you don't care about rates and need lower prices, which means that combined, 92% of you are on the sidelines for buying a house until prices drop meaningfully and or mortgage rates go to 4%. I want you folks to really think about what that says about consumer sentiment, about the housing market, about where the economy is heading. This is a big sample of people, 18,000 voted in this poll. That's about 15 times the sample of a poll that you would see from the AP News or CNBC. And I think you guys are a pretty representative sample of the US consumer. And it's very, very clear. Home buyer demand is not coming back anytime soon, and it's not going to come down until both prices and rates drop meaningfully. I mean, how can the economy actually avoid a recession at this point? I mean, we're in such a bubble all over the place on debt and home prices and stock prices. People are saving no money. And now you're kicking out the stools of what was supporting the economy in the way of immigration, in the way of government spending. I mean, there is going to be some type of pain that comes along with that. And Trump is even telling you that. Trump has come out and said numerous times in the last month or two to expect some pain. His Treasury Secretary, Scott Bessent, is also saying the same thing. He's saying the economy is unstable and that the economy is going to need a detox period, slow down. He says, could we be seeing this economy that we inherited starting to roll a bit? Sure. Look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy become hooked, and we become addicted to this government spending, and there's going to be a detox period. Of course, a lot of people have been calling for a downturn in the economy and the stock market and housing market for the last 3 years, and we haven't yet seen this downturn take place. So some of you out there might be skeptical that we're actually going to see unemployment go up and we're going to see home prices and stock prices go down, because it's now been 3 years that people have been calling for this and it hasn't happened. And I think what makes this time different, everyone, is that we're running out of options. We're running out of moves here in the economy. And the two areas in particular where we're running out of moves and we're running out of room is the US debt and consumer savings. Consumer savings especially are really drawn down, really thin. American consumers do not have any more money to spend. For instance, the personal savings rate in America is now down to 3.8% at the end of 2024 in the fourth quarter, meaning that on average, American households only save 3.8% of their income. That's one of the lowest savings rate of all time. It's about half what it was prior to the pandemic, and it's about 1/3 what it was in the 1960s and 70s. So Americans are saving way less money. They're living more paycheck to paycheck, which tells you that there isn't much room for them to increase their spending. And if anything, there's room for them to decrease their spending, with retail sales now being down in February as tariff concerns add up. The National Retail Federation, alongside CNBC, has reported that retail spending declined in February due to several factors, including cold weather, declining consumer confidence, and tariff concerns. We're down 0.22% seasonally adjusted month over month. Now, that's a key point, everyone. These figures are seasonally adjusted. So a lot of people say, oh, spending goes down in cold weather months after Christmas all the time. That's no big deal. No. We're already adjusting for that normal decline and saying that spending dropped by more than that. Now remember, everyone, retail sales also plunged in January as well. So now we're going to have potentially back-to-back months of declining retail sales. We're going to have to wait for the official February sales figures from the census next week. However, we're starting to see those impacts of the slowing consumer with very little savings starting to cut back amidst massive cuts to government workers amidst slowing immigration. And I just, think, folks, that this cocktail is going to have to produce some type of reset in the economy in the short term. Because I think a lot of you intuitively understand that the economy is in a big bubble right now. Both home prices and stock prices are at their richest valuations of all time, even with the recent correction we're seeing in the stock market. Is take a look at this graph. It measures the aggregate value of the US stock market relative to GDP. And what we can see today is that the total value of the stock market in America is 55.7 trillion, while GDP is 29.1 trillion, which means that we're at an equities to GDP ratio of 191%. This metric is also called the Buffett indicator. It's one that Warren Buffett uses to proxy over undervaluation of the stock market. And you can see we are way overvalued today. The long-term average equity to GDP ratio is 77% going back to 1947. So going back almost 80 years, it shows that we are almost 2x overvalued on stocks. Meanwhile, the housing market to GDP ratio is also similarly overvalued. Aggregate value of the US housing market is $48 trillion. GDP in the US is $29 trillion, meaning that our housing value to GDP ratio is 165%. This is around a similar level of overvaluation to the last bubble in 05-06 before the big crash. And you can see that if we were to actually add the stock market and housing to GDP ratios together, we're at 357%. So there's 103 trillion in housing and stock market value in the US today compared to only 29 trillion in GDP. What does that tell you, everyone? It tells you that the assets are being priced at a multiple to actual economic production that doesn't make any sense. Now, it did make sense for a while, though. Because what happened over the last 2 decades was that the Federal Reserve cut interest rates and printed money. And when the Federal Reserve cut interest rates and printed money, that artificially inflated the value of assets all over the economy. And you can see this clearly on this graph, where the pink line is the 10-year inflation-adjusted Treasury yield, or the real yield, which takes the 10-year US Treasury and subtracts the inflation rate. And what you can see is that real yields started plummeting in the late 90s. Real yields went from 3.4% to basically negative real yields through the late 2010s into the pandemic. And when real yields are negative, that means that actually a 10-year US Treasury is yielding less than the inflation rate, which is very bullish for assets. So when you suppress interest rates that much, that causes asset prices to go up a lot. However, take a look at what's happening now. The real yield on the 10-year US Treasury is climbing. In 2024, it was 1.3%, suggesting that this artificially high asset valuation is unsustainable. Now, again, I know a lot of you are saying to yourself, well, Nick, like, how could this bubble be lasting so long? Why hasn't it crashed yet? This is really frustrating. You see a lot of people out there still try to FOMO others into buying these assets at these crazy high valuations. And I think the thing that explains why we haven't seen the crash yet is the fact that it simply takes time for this stuff to play out. The Fed juiced the housing market, stock market for 2 decades. It was 2 decades of artificially low interest rates and money printing. And so when you stop that and reverse that, which they did about 2 years ago, it's going to take time for that adjustment to take place, especially because so many parts of the economy became reliant on that asset bubble. So many people now make their money off that asset bubble. Think about day trading. Think about all the real estate startups that ended up buying houses and trying to justify their existence by saying that they were, buying houses so people could rent them and then sell to them, or buying homes to flip homes. Like, all these people piled into different industries and raised capital on the idea that this asset bubble was real. So when the Fed increases rates and starts pulling money from the system, you are not going to see an immediate adjustment, because it's almost too hard for the economy to actually admit what's going on. It's too hard. There's too much cognitive dissonance for people to admit what's happening. And so you're going to see the bubble last longer than you think. Now, the other reason why the bubble has lasted longer than you think is because the Fed printed $5 trillion from 2020 to 2021. The Fed printed $5 trillion. And that $5 trillion was still making its way through the system for the last 2 years, even after the Fed stopped printing money. So there was still money sloshing around. And oh, yeah, the government spending kept going up. The debt to GDP went up to 121%. And we had 8 million people cross the border over 3 years from 2022 to 2024, which added more jobs, which added more people coming and working, which added more people spending money. And so that kept things afloat. But now it does seem like some of these things are starting to turn, and a lot of it does have to do with the actions of the Trump administration. For the first time, we have this reality check of both the Fed and the US government presidential administration being kind of on the same page of a certain level of austerity, and the market is having a tough time dealing with that. And we're going to have to see what happens in future months and quarters, because I think the economy right now is hanging on by a thread. And it's not a guarantee that we're going to see a crash this year, but the odds are rising. In particular, the poly market betting odds are now saying there's a 43% chance of a recession in 2025, so almost 1 out of 2 chance. Meanwhile, the Fed Watch tool is now predicting that the Fed is going to resume rate cuts in June. So definitely something shifting right now. If you guys want to track this economy, track the asset markets going forward, make sure to hit that subscribe button and leave a comment down in the comment section below and let us know what you are seeing in the local economy. Are you hearing anecdotes? Are you hearing stories? You guys are my eyes and ears on the ground of the economy and US housing market. Let us know in the comment section what you are seeing, and I will make sure to keep updating you all on this data into the future.